Some of the biggest names like Bank of America and Morgan Stanley declined more than 2% as interest rates fell. So what lies ahead for the sector? Joining us to talk about that is Eric Compton. He's an equity analyst at Morningstar. Eric, welcome. Nice to have you here.
Great. Thanks for having me.
Bob outlined some of the things that are affecting the market, but specifically to the banks, you see the risks more to the downside, more things that could go wrong for the banks than could go right, such as?
That's correct. So our view on the banks at Morningstar, at least for the U.S. banks, has been that the risks are more to the downside at this point. And so that's one way you see that playing out already is with interest rates. And so as interest rates on the long end go lower, that hurts banks' profitability. They earn less on their longer duration assets. And also the worse the economy gets, the more pressure that puts on the Fed to lower short-term rates. And so that would also directly impact bank profitability. So that would be one example, rates going lower, credit costs, slowing growth, a lot of the issues you outlined already.
And yet, rates have been low for more than a decade. We all know that, and banks have learned to cope with that. Fundamentals for the banks are good. The latest earnings reports were very good, and yet the market continues to wring its hand over what lower rates would do to the bank's profits down the road.
I mean, absolutely, yeah. So the rates will hurt the banks. Some banks have adjusted better than others. And so I would highlight the largest banks have stronger fee income streams. And so, as your interest income declines, those fee income streams that aren't tied directly to interest rates serve as, call it, better insulation in times of distress. And so if you're looking for some insulation against that could be one way to play that.
So that gets to the heart of my question. It would appear that the markets are worrying about something that they don't need to worry about. Do you agree with that at all?
I would push back against that a little bit.
Okay.
And so the banks are certainly macro sensitive. Rates is one way. While fee income may provide some insulation against that, lower rates are still going to hurt them. There's no way to completely neutralize that. And then as the economic cycle matures, if we get any kind of turn in that, you could see rising credit costs. And so that would also be detrimental to bank performance. So there's just a number of things that could go wrong. I would say the bull case right now is just that things kind of stay as they are. Nothing goes wrong from here on out.
All right, Eric, thank you so much. Eric Compton with Morningstar.